Okay, this is a very short little tutorial on how to trade a fundamental announcement. So because we're recording this, we have to do the disclaimer. Nobody's telling you can make $3 million in 2 weeks in here. The possibility exists you could sustain a loss of some or all of your initial investment. Therefore, you should never invest money that you cannot afford to lose. Be aware of all the risks associated with foreign exchange trading and seek advice of an independent financial advisor if you have any doubts. So how do we trade the news? Well, first of all, we have to decide whether we even want to, okay? Because it's one of the most risky times to be in the market. However, because it's risky, that means there's lots of opportunity. Now, we at ProAct Traders don't trade fundamentals. We're technical traders, okay? But during a fundamental announcement, the technicals are put on the shelf for just a short period of time, and the fundamentals take over. Okay. Now, since we're technical traders, we wait for the reaction to the fundamentals, and then we technically trade the reaction. All right. So, how do we know when they're going to happen? They occur virtually every day. And the best place to go is Forex Factory. If you're a ProAct Trader subscriber, you have a link to this directly from your info center. But when you get to this page on the economic calendar, right up here it says there's a time right here. And if you just click there, you can set that time zone to where you live in your part of the world. And then it will populate these times that the announcement occurs to your time wherever you are in the world. And you won't have to try to figure out what is that in GMT or whatever it happens to be. So the next box over here, or this next line down here, shows you the currency that will be affected by the fundamental announcement. And then the next one over here is the expected impact. Okay. Now we pay a lot of attention to the ones that are red because they have a significant probability of moving the market. The orange ones mean it may do something, but really not too much. Okay. So that's what we look for, is those red ones. And anytime we have a red one of these little graphs right here, we are flat in the market. In other words, we don't have any trades on. We're waiting for the announcement to take place. This next column over here tells you what the specific fundamental announcement is, okay? And then when we look over here on the right-hand side, and by the way, if you want to find out what that is, just click here in the detail and it'll tell you why it's important to traders. Over here you have a forecast, okay? You also have the previous time that the announcement was made, what was the actual number that it came in at, right there, okay? And then this is the forecast for the announcement that's going to happen whenever it is going to happen, all right? And then as the announcement is released, the actual number is put here, okay? So what happens is if the number comes in exactly or very near to what the forecast was, technicals say that the price is already, the forecast has already been priced in. However, if the number is posted is drastically different from the number they forecast, that means that in the fundamental picture, things were not what they thought, and therefore they will quickly price that new information in. Okay, so you can see, for instance, on this last one here, that's the manufacturing PMI affects the British pound. All right. So the previous month it was 49.5. They forecasted for 49.8, but hey, it only came in at 45.8, and so there's quite a bit of difference between the number that was forecast and what has actually occurred, and so we can expect to see a reaction to that type of thing right here. For instance, down here on the Aussie, building approvals. Okay, 3.3 was what they expected, and it was 6.5, double that. So there's a reaction that will occur because of that. Another place to go is FXDD on demand. They also have an economic calendar there. The only difference here is it's the number of bulls. The 3 bulls means that it's significant. 2 means it might move the market, and 1 means probably nothing will happen. It's just information. So what do we do in a fundamental announcement? Well, the first thing you want to do is change your charts to a 1-minute chart, okay? That's because things are going to happen 10 times faster or more than they normally do. So you're normally trading, looking for entries on a 10-minute chart or whatever you happen to be looking for, and we want to go down to a 1-minute chart. And so basically the only time we ever use a 1-minute chart is in a fundamental announcement. So we then get the news is released and we get a reaction to that news. As you can see in this case, it's a momentum candle to the downside. That's the reaction to the downside. In other words, it was not good for in this case, the US dollar. Right? So what do we want it to do? We want to make sure it goes sideways for 3 to 5 candles. So I kind of blew one up here. See, there's the reaction to the news, and then it's going sideways. And the reason that we want to do that is because if it's a ho-hum, oh well, that doesn't mean that much, then we'll see the candle come right straight back up. It's what we call a whipsaw. And if you entered your trade right in here, you're liable to get stopped out right here. All right? The other thing is, if it goes sideways, it tells us another thing. There are no buyers up here. Okay? If there are no buyers in the market, there can only be sellers. Okay, so we want it to go sideways for 3 to 5 candles. What do we do then? Well, we simply place a pending order 3 to 5 pips below the lowest candle, and that's the wick and all. So whatever the lowest wick is, you would place an entry order below that for the follow-through. We are part of the follow-through. The reaction occurred on the first candle. The question is, will there be any follow-through from the rest of the traders in the world? Okay, so how do we do that? Well, we go to our MetaTrader 4 platform. And we're going to place a pending order, and it's called a sell stop in this case. If the reaction was to the north, it would be a buy stop. Okay, we type in here the price that is 3 to 5 pips below the lowest wick over here, and we place that pending order. Now that doesn't mean the order's in. It'll only get taken in if the market moves through that price. Okay, so we would have had a sell stop executed here. All right. And in a fundamental announcement, you want to use very tight stops, no more than 20 pips. All right, and your job initially is to get that trade to break even as soon as possible. Remember, you're in the riskiest time of the market, and at any time they could lose, momentum and go right back to doing what they were doing. So you want to have very, very tight stops, and you want to move it to break even as soon as possible. Now, for proact traders, because we have bright painted candles that occur when momentum enters, it's very easy for us to see when we move our stop. So we would move our stop anytime we get a break of the paint. So here we had a movement down was bright red, and then we lost all that bright red paint, so we would move our stop at this point. Then we start to see the sellers coming back in again. See some buyers taking some profit off right here, and then down she goes again. And this time we get another opportunity to put another trade in, and up goes, and right in here where we lose the paint, we move our stop. We get another opportunity over here. Actually, a big with a white dot tells us that a lot of money just came in, and because a lot of money came in, we're going to get a pretty good sized push, and we did. These little blue lines here are 30 pips apart. So when that big money came in, it went 60 pips right down to the next target right here. And once it pulls back up here and we lose the paint, we move our stop, protect our profit all the way down. All right. Remember, we're on a 1-minute chart, so things are happening very, very quickly here. All right. So the question then is, well, why not just straddle the thing? Well, first of all, that means that you're willing to accept a loss on both sides. That means that is double the risk, and you're doubling your risk in the riskiest time to be in the market. Okay. Number two, in a zero-sum game, you are now cannon fodder for the market movers. They know where the dumb money puts their straddles, and they will take them out on both sides. All right, so here's an example here. All right, we're getting a fundamental announcement. We had a straddle above here for the buy, and we had a straddle below here for the sell. The market takes off right there. What happens? Boom, here's the example, the exact same trade. They went up here, took all the buyers in, and they came screaming back down, took all the sellers in, and then what did they do? They went in the direction they initially wanted to go in the first place. In the meantime, the buyers and the sellers over here in a straddle are both lost on both sides of that. So straddling is not a great trade setup to use, okay? Not unless you'd like to say, I will take a loss on both sides. And the best thing to do is trade it technically. Use the methodology we just showed you right there. So, thanks for watching. By the way, if we train all the time, train every day, so we'd love to have you come see us. For more free training, visit us at proacttraders.com.